How's it going, everyone? It's Sam. I have something super exciting to talk to you about today. This is something that I was so excited about. I don't think I'm going to post anything else the rest of the weekend. I hope everyone has a great weekend and can digest what I'm about to say. I also suggest doing some research. There's some other great channels that are talking about similar things as to what I'm about to talk about. So let's talk about how you can print money and achieve financial independence, achieve your dream life faster than expected. This is something you've probably heard before, but it's something you might not have looked into because I didn't really look into it too much until recently too, and there's some reasons for that. So this is going to be a long video. I would highly suggest going through, rewatching some parts of it. I'm going to give a lot of different scenarios here. I already recorded part of it, decided to re-record it just to make it a little bit more to the point, but definitely something you want to share around. Now, what is your goal when investing? I asked this to the channel recently. Is it to make enough money to buy whatever you want and get rich? Or is it to make enough money to live on your portfolio and do what you really want? That's the question, because those are two vastly different numbers. If you're looking to buy whatever you want, there's never going to be enough. I mean, sure, maybe you just want a Tesla and maybe you want a nice house, but maybe you want a yacht, maybe you want Lamborghinis, I don't know. But if you want enough to live on your portfolio, that's definitely doable, and doable a lot faster with what I'm about to show you here today. Then I followed this up asking, how much do you spend a month? We have a pretty young age overall on the channel. Most people that watch the channel are between 20 and 30. We do have some people 30 to 35, and that gets less and less as you get older. So a lot of people don't really have dependents. They're under $4,000 a month. We have a significant amount of people, 4 to 6, about 82% of people, about 5 out of every 6 people on this channel spend less than $6 a month. Now, we have some people with some more money that they spend, but what I'm about to show you here today, I have a $50,000 portfolio, so still a significant amount, but it's $50,000, and it's going to push off about $1,500 to $2,000 a month at this point right away after a couple weeks of doing this. And it's not something super risky in my opinion. It's something that, again, I didn't really know about. I had heard of it, but I didn't realize how you could structure it to give you constant income. And it can be used in a very safe way, in my opinion. It actually makes investing a lot less of a guessing game and more of a calculated bet. Now, I'm going to talk about that, but you still have to do your research. So what is the worst part of investing? It's not when we're going up, right? It's when we're going down or we're sideways. That's how you can make money. This strategy is actually where you can make money when we're going down and sideways. It takes a little bit of the potential upside off the table, but it gives you money in the meantime. And let me be clear, this is only part of my portfolio. I still have a portfolio of stocks and a portfolio of crypto that I don't touch. I still have cash on the sidelines, and I think that is really what you should be doing with this portfolio. This is about a little bit over 10% of my stock portfolio is specifically for this. Now, what am I talking about? I'm being kind of cryptic. It is the wheel strategy. Now, if you've heard this and you're just about to tune out, don't. I think this is going to be awesome, and it's a great way of making premiums. It's a great way of making cash every single week from calculated investing. Now, why didn't I get into options earlier? First of all, options are kind of scary. At first, you hear a lot of numbers, a lot of terminology. It's very confusing. It seems like this is just what people are trying to do to get rich really quick, and there are definitely people that are doing that, especially with like AMC and GME. There are people that bought call options way out of the money. Again, kind of jargony what I'm saying right now, but they invested very, very risky, and that's not what we're doing here today. We're taking the opposite side of that bet. We're the people that are going to win the majority of the time. And let me explain why that is. But first, the other reason why I didn't get into this earlier is just because of the fact that I heard so many gurus talking about options, and I just felt like it was gimmicky. I thought it was just people that want to make money by selling something to you. And I'm not going to do that here today. I do have links to the app that I use, that I sell options on. It's Webull. That's where my portfolio is. I have a link to that underneath the video. If you want to sign up there, great. If you don't, that's fine. Let's get on to some of the information you need to know. So first of all, I'm not going to cover what covered calls are and what cash secured puts are too much in detail. I just want to say, in case you don't know what they are, covered calls are basically you have 100 shares and you're giving someone the opportunity to buy those 100 shares from you at some point in the future for a certain price. And by giving that person the opportunity, you get paid a premium up front. So, for example, I could have 100 shares of a stock that's worth $10 per share. So I have $1,000 worth of this stock. I say to someone, hey, if you pay me 50 cents per share, so $50 today, you can buy this stock from me for $12 in the next month. So if we go past $12, let's say we hit $20, well, I sell the stock at $12 and they get to collect all that upside. And they just paid 50 cents for that. So that's awesome in that scenario for them. Every other scenario, if we go sideways, if we go down slightly, if we go up slightly, I'm making out like a bandit because I know that the majority of the time we're going to trend sideways, especially in like a 1, 2, 3, 4 week period. The fact is you don't really see stocks move up 20% too often. And you can play with the numbers. You can set different expiration dates. You can set different, it's called strike prices, the prices that you're willing to sell at. But that's basically what you're doing. You're giving someone the ability to leverage out, pay a small amount up front for huge upside if we go to the upside very significantly, but you collect money in the majority of the circumstances. And you're also setting a price that's above the price that you bought, hopefully, that you're willing to sell at. So if it goes to 20, well, you still got a 20% return, plus you got the premium up front. So that's basically what you're doing when you're selling covered calls. Now, the other side of that is selling cash secured puts, basically saying, hey, if the stock price drops drastically, I'll buy it at this price. And I don't care if it drops significantly more than that. If you pay me a premium up front, I will buy it at this price. So let's take the same scenario. Let's say there's the stock, $10 a share. And I think, I just don't want to buy it now. But if it was at $9, I'd buy it. Well, you can get paid to sign a contract, basically, or to agree with someone else that you will buy those shares at $9. So they might pay you 50 cents to have the ability to sell you those shares at $9 at some point in the future. So you could set it 1 week out, 2 weeks out, 3 weeks out. The longer out, the more you'll get paid in premium. But that's another great way of being able to buy a stock at a lower price than it is right now and then collect a premium up front. If it doesn't get down to that price, let's say you sold the strike price at $9 and you got 50 cents in premium, it's a $10 stock. If it doesn't get down to $9, well, you collect that premium and that's it. You don't have to buy the shares if it's after that date. So it's a great way of just making money on your money. And basically what people do when they run the wheel is they sell these cash secured puts. So they have the cash in their account. They say, hey, I'll buy 100 shares of Tesla if it falls to $200 a share by next month, right? I will buy that. You have to pay me up front for that kind of agreement though. So you might get, $10 per share, $5 per share, $2 per share. We'll get into specific examples for how much I'm making. And then after that gets assigned, after it actually falls down, eventually maybe it takes several times selling these contracts where you get premium up front. Maybe it gets assigned and then you run the covered call strategy on it after that point. So let's get into some examples because I think for me, whenever I hear something like this, it sounds too good to be true. I want to break down the numbers and see all the different scenarios, which is what we're going to go through next. So we're going to go through the best stocks to do this with, the stocks that I'm doing this with, why you want the other stocks that aren't included in this, like you just want the moonshot bags. We're going to talk about specific examples, and I want to know what you want to see also, but we'll go through all that other stuff after these different scenarios. Okay, so let's take a look at the first scenario here, where you buy 100 shares of some stock, and you buy it at $10 per share. Let's say that you are setting the strike at $12. So you are willing to sell these shares at some specified time in the future or before, just before the expiration date. You're willing to sell them for $12. You get a premium upfront for selling these shares, or selling this contract, I should say. You get 50 cents per share. So you're going to make $50 from this. in most scenarios, stocks kind of just go sideways, right? They might end up a little bit higher, a little bit lower over some time period. But if you're looking at a week or a month, obviously they can move up and down. But generally, we're not making huge moves, right? Even if a stock moves 12% throughout the year, it's moving like 1% a month. So the majority of times, they're just going to go sideways, a little bit up, a little bit down. So in this scenario, P final equals $10. So at the end of the 1 week period or something, it's $10. So you were able to get a premium upfront. You spent $1,000 on these shares. You got the premium, which is $50, 50 cents per share. You were able to lower your cost basis to $9.50 per share. That's fantastic. This is one of the really good scenarios because versus holding just the shares and just sitting on them, you made money, right? You were able to come out, you were able to lower your cost basis by 50 cents. You were able to profit, and you get the cash up front at the beginning of this time period. So as soon as you sell this contract, you're able to get that premium of $50. Now you might be saying, oh, that's not that significant. The fact is, I think it's going to go up really fast, but think about this, right? How often do we get significant moves? This is one of the things that stopped me from wanting to sell options in the first place because I thought so many of the stocks I was buying were going to go to the moon, or I thought they were going to go up significantly, like 30, 40%. At first, it was because the market was doing so well, and then it was because the market was selling off. I thought I don't want to give up some of that upside, which is where having that other portfolio where you just hold on to the shares comes in really handy. That's why you only do this with part of your portfolio. So in this scenario, we won, right? The price went sideways. How about we go and we do the best case scenario next? So best case scenario is throughout this time period, it goes up. At the end of the period, we're at $12. So we were able to get $2 worth of price appreciation and 50 cents a premium. So whether they exercise or not, it doesn't really matter because they're basically saying that they're going to be willing to buy them for $12. It ends up at $12. So we were able to get $2 of appreciation. Our shares are now worth $1,200. And we got the $50 in premium. So we got a value of $1,250. We still have our original shares that we bought for $1,000. So we came up 25% up. So at this point, you might be thinking, this sounds too good to be true. What's the catch? Well, there are two main catches. There are two main problems that you can still run into. Let's say you bought some stock and it was just kind of a crap stock. You bought it overvalued and it ends up at the end of the time period being worth just $6. So in this scenario, you lost money. Now you have $600 worth of stock. You paid $1,000 for it. You did get premium. So fortunately, you were able to collect a premium. You basically lowered your cost basis from $1,000 down to $950, but it's only worth $600 now. So you're down in the hole $350, right? So you still came out negative overall, but this is still better than just holding the shares themselves. Because in this scenario, if you had just held the shares, you would be down $400. So it still comes out ahead versus just holding the shares in a downward scenario. The problem is, though, if you buy a crappy stock and you sell calls on it, you're still going to lose a significant amount of money. And if you're down here at $6, it's going to be really hard to sell calls. The reason for that is you can still sell them, right? Let's say you sell at $7, right? The strike price is $7. This is strike here. So you sell the strikes at $7. The problem is, what if it goes down further, right? It goes down to $4. So then you're at $4 in price. Then you sell the calls, the strikes for $5. And then let's say it goes to $6. Right? You just sold at $6. You collected some premium here, but you sold at $6 and you bought at $10. Chances are you probably lost a significant amount of money. What you want to do in most scenarios is either wait for the price to go back up or still try to sell calls that are way out of the money up here. Basically out of the money meaning they're not close to the price of the shares right now, and just collect small amounts in the meantime. So that way you still come out ahead. But this is not going to be a fail-safe to picking bad stocks at bad valuations. So you still have to pick good stocks at good valuations to make this work. The other scenario that I think that stops most people from wanting to sell covered calls is the moonshot. So you sold the strike at $12. You got the premium. you still got a 25% profit, right? Because you sold and you got the premium. What if the price ends up at $20 though? So you sold $12.50. This is how much you make. This is how much you would have made, or this is how much the value would be if you had just held the shares. So this is not better than holding shares if you have a moonshot. There, you actually lose out here. But you have to remember that you picked a specific number. You were the one that decided that you want to sell at $12. You can sell it more out of the money. You're just going to get paid less premium if you do that. So you were willing to take a win at 25% up. That's your capped benefit on this. It can still be painful to see this though. This is a better scenario than the last one because you still end up profiting, but you don't profit as much as you would have, which is why, again, I think it's important to hold shares that you're not running covered calls on just mentally because you know you're still going to win with those shares if you go up significantly. And you also just have to realize that that is what you're giving up. You're getting steady profits, steady income to give up some of that upside. Just something you have to keep in mind. And you have to remember too, if you're selling like 1 week out calls, what are the chances that this happens, right? Maybe you move up 20%. That's a significant move in a 1 week period, even a 1 month period, even in a year. So the fact is there aren't too many scenarios where a stock goes in doubles, right? Just keep that in mind. Something else that could happen is you move up just slightly above that strike price. Maybe you get up to $12.50. That's really equivalent to just holding the shares because you got that premium, you got the strike price selling at 12. If you had held onto it, you would just have the shares at $12.50. So that's one scenario. The other scenario is it goes slightly down and maybe you end at $9.50. That means you basically broke even. And if you just hadn't bought the shares, you would be at the same price. Maybe you go and you were able to just hold out and not buy the shares at all. And you have neither lost money or made money over that time span. But the fact is that's still better than holding the shares without selling the call because then you would just be at a cost basis of $10 per share instead of $9.50. So what you want to do is you want to be able to get into times where you believe in a stock, but it goes sideways, right? Or it goes slightly up. Maybe it goes like this. Maybe it goes slightly down, but not significantly. This is where you win. This is where you profit significantly. If it goes up to the moon, you lose out. If it goes down, you still lose because you picked a crappy stock, essentially. So that is how to sell covered calls. That's why you would. That's how you profit. That's all the scenarios that you could have. Now let's take a look at my exact portfolio and how much money I'm making, what I'm trying to do, what I'm looking at. How do you know what stocks to sell on? What kind of bets are you taking? Let's take a look at all that right now. So this is inside my Webull portfolio. Again, this isn't the most user-friendly, I think, way of looking at this. It's a lot easier on your phone, but I have my computer pulled up so we can take a look at a few different things. So I have 100 shares of Tesla, I have 100 shares of Amazon, and I sold 5 cash-secured puts on Palantir. So let's take a look at this. I have 100 shares of Tesla. I was able to buy at a cost basis of $267.64. This was a little while ago. I'm up just a little bit on these shares. It took a while to get these shares. I didn't just go all in and buy them in one day. I continued to dollar cost average until I was able to do this. So this is my average price. What I did recently was I sold a covered call for a $290 strike price on September 9. So I have 8 days until that date. And if Tesla does not go above $290, this will not be assigned. What this shows is I was able to sell this at $325, $3.25 per share. And now it's worth $2.86. So what does that mean? Well, that means I profited the difference. If we don't go over $290 in this time period, I will get this entire premium of $325. I already got it as cash in my account, but I'll be able to hold onto the entire amount and not have to sell my shares. So again, if we go sideways, if we go up slightly, if we go down slightly, I'm going to profit from this most likely. Today, the price of Tesla stock actually went up a little bit. If you look here, we were up 0.5%, 0.56% through the day. But even though we went up, the value of my covered call I actually made money on it because there's time decay, right? There's a certain time period where this can go up, right? We have 8 days, 6 trading days. If we don't go up a couple dollars every day, the fact is this becomes less valuable because there's less and less of a chance of Tesla going to $290. Amazon, I had something similar happen, right? I have 100 shares. I bought them at $112.93. I've been selling covered calls on it. Right now, I sold this yesterday for $1.10 a share. This is a $133 call, September 9. So again, 8 days in the future. If we don't go up from $127.85, if we don't go up to $133 in that time, I collect all the premium. I don't have to sell the shares. This is, again, just a good way of collecting passive income. So just in these 2 different options plays this week, I made $435. How do I get that? $3.25 times 100, 325, $1.10 times 100, $110, $435. Plus, I also sold some puts on Palantir. So what this means is I will buy 500 shares, 100 shares per contract of Palantir if it falls below $7.50. Now, I've lost money on this. The reason for that is Palantir is actually fallen down. So Palantir is below $7.50 right now, which means I have lost value because of the fact that I will probably have to actually buy these shares. So I still got the premium up front. I was able to make $19 per contract. And at the time, right, Palantir was around $8. So I was saying, hey, I am happy to buy Palantir at a decreased valuation if you pay me up front for it. Now, this is a scenario where I will probably get assigned these shares. I will have to actually purchase these shares at $7.50. And then I will go and start selling covered calls against it. So I'll start with a $7.50 cost basis minus the $19 per share. So it actually comes in a little bit below $7.50. So $7.31 basically is my cost basis if I get assigned these shares. Then I will sell covered calls, hopefully at $7.50 or $8. And then I will continue to do that to lower my cost basis over time. So this is a very useful spreadsheet I took from another YouTube creator. They put in a video of theirs, In the Money. It's a great channel to watch. What this shows is how much you actually should sell your calls for, and it logs every single time that you have sold contracts. So at the beginning, I bought 100 shares of Tesla. I paid about $27,000 for those 100 shares over time. Then on the 25th, I sold the covered call. I sold it for $300. And then I closed it. I bought to close it. I was in the profit a significant amount. So that's something you can do if you are getting to the end of that contract, but maybe you think the shares are oversold, or maybe you think some news is going to come out, some good news, or maybe you just want to take the profit. You can buy to close and you actually pay a certain amount, and then that contract is all done for you. So I paid $53. I collected the $300, so I was up $247. Then a few days later, we kept on falling. I sold that covered call that was out of the money significantly at $290 for $325. So at this point, I am up pretty significantly on that call. I think it was 20 or 30%. And if I want to, I could buy to close. I would have to pay to close out that contract at this point because it's not the end of the period. And then I could just take my profit. So this is how much I paid for these shares. It's $26,439. That means my cost base is $264.39 with 100 shares. Basically, this shows that I want to sell these covered calls above this amount because that means I would profit in the end from selling them here. So I've done that on each of my different positions here. I will continue to update it over time. If you want me to update this as time goes on and give you regular videos, I can definitely do that. But I think this gives you a good overview of the different scenarios and covered calls, and it can show how much you can make, right? For my $50,000 portfolio, it's actually a little bit less than that. I was able to make about $535 just this week from selling a couple cash secured puts, from selling some covered calls. And again, I lose out on potential upside, but I also am guaranteed a certain premium up front. So the fact is that selling covered calls wins out in the majority of scenarios. The only scenarios where you really lose, again, is if the stock price falls pretty drastically, which it still wins out versus just holding the shares. Or if you moon, you lose out. But again, you're setting a specific amount that you are willing to sell at in the future, a certain price. So what kind of stocks do you want to do this with? Some people just don't have that many options, right? You can only buy or you can only sell covered calls on positions that you have 100 shares of. So you want to make sure that you have enough money to actually sell the covered calls. You can't do this with 10 shares or something like I said. And then there are different scenarios or different ideas for what kind of companies you want to sell this on. You want a company that you are bullish on, but you're not married to. You're willing to sell at some point in the future. Tesla, I like more than any other stock out there. I do. It's my largest position of all my portfolio. But this is only a portion of my shares. So I realize that I might have to give up these shares when I think they're worth more. But I'm willing to do this because I realize the premiums are quite high. And if we take a look at Tesla stock, I can show you why that is. So there are a couple different things that affects the premium that you get paid for selling a covered call. One is the implied volatility of the stock. How much does it move up and down in a day? Obviously, if something is more volatile, you're going to get paid more because there's more of a chance that you're going to hit certain strike prices. The other thing you can look at is what your strike price actually is. If you're closer to in the money, or if you're closer to the price of the stock, the fact is you'll get paid more for selling covered calls. If it's more out of the money, you're going to get paid less because there's less of a chance that it's ever going to hit that number. If I picked $1,000 for a Tesla covered call and I sold that, it wouldn't be worth very much because there's a very slim chance that that will actually happen. The other thing is how long out in expiration you're looking at. Right now, I'm selling 1 week covered calls. So I'm making, again, like $500 a week from covered calls and cash secured puts. But I could make more if I looked further on in the future. It would just be I don't get paid as often. So why am I picking the 1 week? Well, it's easy to kind of chunk up the risk reward of that because I really don't know where Tesla is going to be in a month. I look at some of the things that are coming out. They're going to release their deliveries. I think that could be bullish or bearish for them. Am I willing to take that bet? I don't know. I don't know if I want to push it out that long. Also, because we have CPI and the Fed meeting. So there are a lot of different things that could affect this. Also, the fact is we've been going down a lot, right? The QQQ and the NASDAQ are down pretty significantly, about 12% over the last couple weeks. So I realize that we could have a bounce, which is why I do these shorter calls. Now, right now, if you want to sell a covered call for a $290 strike price, exactly what I did, right? You would get somewhere between $2.94 and $2.78. Basically, people are willing to pay $2.78. People want $2.94, and that's where that bid-ask spread goes. If you go more out of the money, so you go to $295, there's less of a chance that's going to happen. So your chances of winning this kind of bet where you get paid, but you also don't have to sell your shares, that goes up, but you're going to get paid less for it. So about $1.75 instead. If you're willing to sell at $280, so chances are, in a day you could have it hit a 280 pretty easily. If we just went up 1%, you would get paid significantly more, about $6.50 per share. So $650. Now, how do you pick which one is right for you? It's going to depend a little bit on how bullish you are on the stock, what you see in the future. But one thing that a lot of people look at is the delta. This is basically the probability that one side's going to win or the other. So if you have a 0.3 delta, it's about a 70% chance that it will expire out of the money. So you will collect your premium, you won't have to sell your shares. And then there's a 30% chance that it will expire in the money. So you will have to sell your shares. You'll still collect the premium, but the chances are 30% or so that it will expire and you'll have to sell your shares. Now, of course, this isn't perfect. This is the options chain, though. This is the delta, and that's what that's there for. Now, of course, this is not perfect, right? They're not accounting for deliveries and CPI data in these numbers, but this is just the delta based on statistics. So I picked about a 0.25, I believe at the time, or 0.3 delta. That's basically what I'm comfortable with. I don't want it to go in the money every single time. I want to hold on to the shares in the majority of circumstances because, again, the best case scenario is we get up to 290 at the end. I collect all my premium and my shares are worth more. And then I do the same thing. I sell 305 or 310 call, and then we move up to that point and I continue to collect premium, and then we keep on getting higher and higher. I collect more and more premium, but I still get to hold on to my shares. What I don't want to happen is we fall down to $260, and then we fall down to 250, 240, 230, 220. At that point, I'm going to have to sell way out of the money, and I'm not going to get much money, right? As you get more and more out of the money, you don't get much. And then I need to continue to sell above $264 or $267 at this point to profit on this trade. So that's what I don't want to happen. But the fact is, I still like Tesla at those values. So that's where it's nice to have some cash on the side, because you can just go out and buy more shares then. If I'm not willing to sell covered calls for $260, maybe I want to buy more shares because I think it's undervalued at that point. So that's another scenario where it's really good to have some cash on the sidelines just to help your own sanity in case we do go up or in case we do fall down pretty significantly. Now, the other side is the cash secured puts. You're saying 8 days from now that if I want to sell a $270 strike, that I would pick up 100 shares. I would pay $27,000 for 100 shares, and I want money for that. I would get about $500, right? Between the bid and the ask. So this is a little bit different than selling covered calls because, again, you have the cash. So right then, it's really just dependent on how bullish you are on the stock and how much are you making per week at that point. Because you can get greedy. You can go right around the cost of the shares right now. You could go for a $275 strike price right at the money, or at 277, something around there, and you'll get more premium. But the fact is, it's a lot more likely that it gets in the money, and then you have to buy those shares. Now, best case scenario here, it could be different for different people, right? Maybe you just want to buy the shares and you think it's already at a good price, so you're going to collect a little bit more premium. You want to go right at the money. Maybe you say, hey, I don't really want the shares, but I want that sweet money. So I'm going to sell 265 strike. I don't think it's going to hit that for technical analysis reasons, or I think there's going to be good news or something. And I'm willing to collect $350 for that. Now, this is where it gets really interesting. Let's say you had this $27,000, right? And you are collecting $500 a week in premium. That's a pretty good return. If it never actually gets assigned and you're able to collect $500 a week, that's $26,000 throughout the year. And you had about $27,000 in collateral. So you could make 100% profit. Now, of course, like I said, the chances are it's probably going to go in the money at some point, and you're actually going to have to purchase these shares because the delta is 0.3. So about 7 times out of 10, you won't have to buy the shares. About 3 times out of 10, you do. But again, this is just really interesting because maybe you do this 3 times, you make $500 each time, and then eventually you hit 270. Well, you made $1,500. You had your collateral there for 3 weeks, and then you got the shares at 270. Maybe it goes down to 270 and then goes to the moon. Maybe it goes up to 1,000 after that. So you were able to collect premium in the meantime with just some money that you had sitting there. And then eventually you picked up the shares at a price that you want, and then it goes up from there. Now, there are several different scenarios that can happen when you're selling puts. It's kind of a different worst case scenario. What you don't want, again, is for the price just to drop drastically. That's really what you don't want. But again, it's the winning scenario is going to be different for different people. Maybe you just never want to get assigned. Maybe you just want to continue to sell your cash secured puts and collect that premium. You never want to actually run the wheel strategy where you start selling covered calls. So maybe you go more out of the money, right? Maybe you sell something up here and you collect less premium, but there's less of a chance that you're going to have to actually buy those shares. Again, though, this is another scenario where if you sell a 270 strike and then it goes to $100. You still have to buy at 270. So you can lose a lot of money doing this. So you have to be careful with what stocks and what strike prices and what valuations you're willing to pay. That's something you have to pay attention to, because this is, again, not a catch-all for just bad stock picking and bad valuation picking. So that is the wheel strategy. Now, there are definitely some ramifications. There's some pros and cons of running this strategy. You're giving up potential upside on the covered calls scenario, and you're also assuming some risk in case the stock falls drastically on the cash secured put side. But overall, this really does kind of round out your investing journey. It makes it a lot easier because a lot of the time you aren't going to have drastic moves in price, and you're going to be able to collect premiums, essentially making stocks almost like dividend stocks and collecting income in the meantime. Now, there are a couple things you have to pay attention to. If you've held on to shares, and depending on your tax circumstance and how much you make and what and where you are, the fact is, if you've held on shares that have gone up drastically in price, it might not be worth running this strategy. For example, if you're up 1,000% on Tesla stock, you might not want to sell a lot of your shares for tax ramifications. You're also taxed at your income tax for some of these premiums, but also, if you just make money here in the US, you're probably going to have to pay taxes. So that's not really a good reason, I think, to not run the strategy. It's just something that you have to take into consideration while you're planning out how much you're going to make. And that's why I kind of went through at the beginning how much people really need to live on. Right now, $500 a week on a $50,000 portfolio. I realize that's not a small portfolio by any means, but also that is definitely doable for a lot of people. Over time, if you can get 20, 30, 40, and right now I'm making 50% returns on this portfolio just from the premiums, not accounting for any potential upside, any potential downside in capital appreciation or losses. The fact is, that's really good. And of course, it's going to come down to the stock that you're picking to, and there's going to be some luck to it. Again, if you pick it and it just goes down pretty drastically, it's going to be hard to sell covered calls. You might just be a bag holder for a while. But then that is a good time, again, where if it goes down drastically and you still like the stock, that might be a good time to start adding to that position, maybe selling some puts. So definitely let me know if you want me to cover this more in the future. There's no such thing as a free lunch, and there's definitely some risks and rewards with this. But if you want me to show this every single week, let me know down below in the comments section. There is that link to Webull where you can actually get up to almost $30,000 worth of free stock if you're really lucky. So definitely check that out. You're going to get some free stocks right off the bat. So you do get something when you use Webull, and it's really easy on the phone to trade options. I really like it. So check that out underneath the video. Thank you. If you want to know what I'm doing every week, I will probably start covering this in the Patreon too, and I'll be a lot quicker to update in the Patreon. Thank you so much. Both of those links are underneath the video, and I'll see you in the next one. Bye.